the macro discussion, which a lot of your clients would be asking you about in terms of the election verdict impact on the state of the economy and the macro outlook thereof.
Good morning, Tanveer, and good to be back on your show. So clearly, post-elections, the discussion we are having with the investors has been what does it mean for the fundamentals? Investors have quickly gone back to reassess the fundamentals. The focus is more on how the GDP growth is shaping up and what does it mean for the banking space. Just to remind your viewers, are three important points in the sector that we're highlighting to the investors. Number one, clearly the Goldilocks period that existed for the Indian banks for the last couple of years seems to be coming under some pressure. There have been some increase in headwinds, particularly from the side of liquidity, as well as some increase in credit costs, particularly in the unsecured loans. And that's the reason why the earnings is something that investors are focusing on, and basis that the stock performance would be evaluated. Having said that, given that the risk reward in private banks looks quite attractive, given that many of these are trading at below their long-term averages, investors spending more time over there compared to the public sector banks, which have had a good run over the last couple of years. And that's where the incremental debate has been centered at, as to what does it mean for the state of banking affairs over the next couple of years, and which set of banks would you be better off owning?
And you prefer Indian private banks over PSU banks?
That's correct. We believe that there is a better risk reward in owning the private banks, of course, selectively, given the valuations versus the return probability, the potential that they will generate over the next couple of years, plus the gain in market shares compared to the public sector banks. What we observed in the last 12 to 18 months, given that the debate has been squarely on the deposits, the private banks have been able to put up a good show there and have been able to gain more market share compared to the PSU counterparts. Whereas what you've seen is the valuations in PSUs have re-rated, and now perhaps would be factoring in a neutral risk reward compared to the private banks.
What about loan losses and bad loans, asset quality concerns, and how do you see the quality of the book on the retail side versus the corporate side? Corporate credit and consumer credit?
Yeah. So look, I mean, the corporate side of the story is still pretty good. We've not really seen any episodes of bad loans getting formed there. And on the other side, the upgrades and the recoveries have been pretty strong on the corporate side, which to some extent also help the private public sector banks. Whereas on the consumer side, which have had a pretty strong run, growing at mid-teens to high teens over the last couple of years, there we are seeing some pockets showing some signs of stress. We have been highlighting to our investors about them being wary of the unsecured book. We've seen some of the players, particularly in the NBFC space, report higher formation of NPLs out there, and therefore the credit costs have gone up over there. But barring those episodes, I think overall the asset quality health for the overall sector remains quite healthy. And therefore, the growth outlook continues to remain healthy, though it will moderate from the high levels of 15 to 16% that we are seeing at this point of time. So our investors, while they focus on this in specific buckets, which will impact specific names, overarchingly, our investors are not overly worried about asset quality. The focus is more on profitability as well as growth.